When you think of a successful company, profitability probably comes to mind. Yet, many well-known companies are unprofitable but still manage to stay in business. How is this possible? How can companies that lose money continue to operate and even thrive? This is the story of how unprofitable companies stay in business. To understand this phenomenon, we need to look at several key strategies and mechanisms that allow unprofitable companies to keep the lights on. These strategies often involve leveraging investments, focusing on growth, and employing innovative business models. One of the primary reasons unprofitable companies can stay in business is venture capital and private equity funding. Venture capitalists, VCs, and private equity firms are willing to invest large sums of money into startups and unprofitable companies with the expectation of future returns. These investors are not looking for immediate profitability. Instead, they are betting on the company's potential for explosive growth and market dominance. Companies like Uber, which was unprofitable for years, managed to raise billions in funding because investors believed in its long-term potential. VCs and private equity firms provide the financial runway that these companies need to grow, expand, and refine their business models. This influx of cash allows companies to focus on capturing market share, developing innovative products, and scaling operations without the immediate pressure to turn a profit. Another key factor is the public markets. When companies go public through an initial public offering, IPO, they can raise significant capital from investors. The stock market values growth and future potential, often more than current profitability. For instance, Amazon was famously unprofitable for many years after its IPO. However, investors were willing to buy and hold Amazon stock because they believed in Jeff Bezos' vision for the company and its potential to dominate e-commerce. Public companies can issue new shares to raise additional funds, which can be used to invest in growth initiatives, research and development, or acquisitions. This access to capital markets provides a lifeline for unprofitable companies, allowing them to finance their operations and strategic goals. Additionally, unprofitable companies often rely on debt financing. They can issue bonds or take out loans to raise money for their operations. While taking on debt carries risks, it can provide the necessary capital to invest in growth opportunities. As long as these companies can manage their debt and maintain investor confidence, they can continue to operate despite not being profitable. One of the most famous examples of a company that remained unprofitable for years while continuing to thrive is Tesla. Founded by Elon Musk, Tesla focused heavily on growth and innovation, often at the expense of profitability. The company invested heavily in research and development, manufacturing capabilities, and expanding its product lineup. For years, Tesla reported losses, but it continued to raise capital through equity and debt markets. Investors believed in Musk's vision of revolutionizing the automotive industry with electric vehicles, and their faith paid off when Tesla finally turned a profit and saw its stock price soar. Another example is Spotify, the popular music streaming service. Spotify has been unprofitable since its inception, primarily due to high licensing fees paid to record labels and artists. However, the company continues to attract millions of users and has a strong revenue growth trajectory. Spotify's strategy involves focusing on user growth and market penetration, believing that profitability will come as they achieve economies of scale and negotiate better licensing deals. Unprofitable companies also stay in business by reinvesting their revenues into growth initiatives rather than focusing on short-term profitability. This approach is common in tech startups and companies in rapidly evolving industries. By prioritizing growth, these companies aim to build a strong market presence and achieve a competitive advantage. Once they have established a dominant position, they can then turn their attention to improving profitability. Take Amazon as an example. In its early years, Amazon reinvested nearly all of its revenues into expanding its product offerings, building its logistics network, and enhancing its technology infrastructure. This aggressive reinvestment strategy helped Amazon become the e-commerce giant it is today. Only after securing a dominant market position did Amazon start to focus on profitability, and it has since become one of the most valuable companies in the world. Another strategy unprofitable companies use is developing innovative business models that can generate future profits. For instance, many tech companies adopt a freemium model, where they offer basic services for free to attract a large user base and then charge for premium features. This approach allows companies to build a large and engaged user community, which can be monetized later through subscriptions, in-app purchases, or advertising. Consider companies like Zoom and Dropbox. They offer free versions of their software to attract users and then charge for additional features and services. This model helps them build a loyal user base while generating revenue from those willing to pay for enhanced functionality. Partnerships and strategic alliances also play a crucial role in the survival of unprofitable companies. By forming partnerships with other companies, they can share resources, reduce costs, and access new markets. These collaborations can provide a much-needed boost to their business operations and help them stay afloat despite ongoing losses. For example, unprofitable pharmaceutical startups often partner with larger pharmaceutical companies to share the costs of research and development, clinical trials, and regulatory approvals. These partnerships allow smaller companies to leverage the expertise and resources of established firms, increasing their chances of bringing new drugs to market. Finally, unprofitable companies often benefit from favorable economic conditions and market dynamics. Low interest rates, strong consumer demand, and investor optimism can create an environment where unprofitable companies can thrive. In such conditions, investors are more willing to take risks on companies with high growth potential, providing them with the capital they need to continue their operations. However, it's important to note that not all unprofitable companies will succeed in the long run. Many will face challenges that they cannot overcome, such as changing market conditions, increased competition, or the inability to achieve profitability. The key for these companies is to have a clear path to profitability and to continually adapt their strategies to changing circumstances. In conclusion, unprofitable companies stay in business through a combination of venture capital funding, access to public markets, debt financing, reinvestment in growth, innovative business models, strategic partnerships, and favorable economic conditions. These factors allow them to focus on growth and market dominance, with the expectation that profitability will come in the future. While this approach carries risks, it has led to the success of some of the world's most iconic companies. Thank you for watching, and if you like this one, subscribe to Luxe and check out some of our other videos.